And this is a stock that we used to cover quite a bit because Steve and I used to own it, so it was quite fun to read about it and obviously update you guys. But yes, this is Forterra. Forterra, for those who don't know, and you wouldn't guess from the name, it's actually a brick maker. So it sort of makes clay bricks and it makes blocks and things for like beam and block floor. And it also makes brick slips, which are kind of like fake thin bricks that people use to make it look like they've got a brick effect or something like that. Sometimes it can be used for cladding and things like that, but I think the most common use in my head that will probably help you is that people tend to stick them around the fireplace to make it look like they've got like a clear brick fireplace when they don't. It's just been like stuck to plaster. But anyway, look, so I've got a couple of reports here from you just to sort of just to compare the two sort of March to sort of May statements to see how you think they're going, really. But there was a 45% increase in pre-tax profit back in March. 2024 was a pretty weak year for them, but they were up to 24.8 million. A slight dip in revenue of about 0.6%. That took them to about 344.3 million on the year. So despite the profit growth, though, the company has finally reduced that dividend, Steve. We were complaining about Forterra back in the day. They were really trying to keep their dividend going, and in doing so, and in the process of swapping CEOs, they took on some debt to continue paying the dividend, and Steve and I were like, off you go, that's enough of that. That's a very bad decision, but actually we look like we're getting into an interesting kind of place here. So a 45% increase in pre-tax profit, a slight dip in revenue. They've cut the dividend by 32% to about 3 pence per share. And they've said that this is challenging market conditions that they think are impacting the balance sheet. Plans to restore the dividend when conditions improve. Of course they do. It's a dividend kind of, the dividend experiment, we call it like a dividend natural kind of company. It's kind of, one of those companies that would naturally pay a dividend. So yes, they said that the actual market towards the second half of 2024, there was improving. They highlighted successful alignment of production, some strong cash generation, and they also made significant progress on 140 million capital investment program, which they said is nearing completion. Net debt stood at 84.9 million, which is quite a chunk. Yes, so the 140 million capital investment program, this is a major initiative to modernise and expand its manufacturing capacity. And you'll remember we talked about the Desford site, but they added the Wilmcote and Accrington sites as well. So this program is nearing completion. It's going to improve brick production by about 15%. They also improve efficiency and sustainability. They've got new kilns going in, new technology, and it's going to enable the production of things like brick slips at Accrington, which they think positions Forterra to meet kind of the future demand that in the UK construction market. So they reckoned back in March, EBITDA of about 120 million in the medium term, positive trading into early 2025. They said that brick dispatches in early 2025 are up 17%. Which is pretty good. They expect to implement some price increases to try and counter inflation, but they remained optimistic about the market recovery driven by government house building ambitions whilst acknowledging ongoing macroeconomic uncertainties. Let's fast forward to last week. Forterra announced a 22% increase in revenue, Steve, to 124.1 million. This was the first 4 months of the year, so it's a third of the year. I don't know why they're doing that. That really hurts, but that's what they're doing. Strong performance in bricks and blocks and their bespoke product division. And they said this is primarily due to higher demand from the house building sector, although the repair and maintenance sector was pretty subdued. I can tell you that is industry wide. If anybody is dealing with the major house builders, you'll find that for the last few months, for whatever reason, they've been taking up a large proportion of your order book. It's certainly been the case at our place as well. So yes, 17% increase in brick dispatches continued. They're actually going to continue increasing prices now to offset inflation, actively managing production capacity now to meet demand, including boosting the concrete floor beam output and preparing to increase brick production at Desford. They've also made good progress reinstating the Wilmcote brick factory. They've been commissioning the Accrington brick slip production facility, and they said that the kiln at Wilmcote is going to be lit imminently. So they're anticipating continued strong demand. They remain aware of these macroeconomic uncertainties I mentioned before, and obviously tougher comparisons as 2025 progresses. But despite these factors, they expect to benefit from a market recovery, especially if the government continues to commit to increased house building. Don't know if you're on LinkedIn. Keir Starmer put out a call to house builders to stop messing around and start building. And to be fair to them, they certainly have been. Net debt, though, Steve, has gone from 84.9 million to 88.4 million, and it's now about 1.7 times EBITDA. Year to date, stock's up about 22%, 419 million market cap, PE of about 23, Steve. How do you feel about this one today, considering how you felt about it probably this time last year?
Better. One of the things I didn't like, well, I mean, yeah, we got really cross at this about a year or so ago, because there were a few reasons that the market was getting quite cross at this, and not all of them were our reasons, in fairness. One was that they seemed, the market, unimpressed at the fact that they had basically invested heavily at the top of the cycle into their Desford facility and others as well. And then sort of immediately after basically nearly completing that, they were then shuttering and mothballing all their other factories because demand had gone away again. And that seemed like quite bad timing, that they'd put in a big CapEx push at a time when they weren't going to be able to use it for anything. And that might be right, but sort of don't mind that with this kind of business particularly. I'm worried about particularly cycle timing. Do what you got to do when you got to do it. And get on with it. And if things, over the long term, these things will wash themselves out. What I didn't like was that they were continuing to pay a dividend while their net debt was going up, because they went from being basically net cash positive when we were first looking at these, to in debt, to pulling revolver, to in danger of breaching covenants. I think they'd had to renegotiate some of them, or had them adjusted to try and stop themselves bumping into their covenants, which would be big trouble if they had gone through them. And there is an extent to which, okay, I get this is cyclical, as I just said, and I don't hold them responsible for when things go where in the cycle, but you do need to be aware that things do get better and worse, and you have to be, at least in some sense, prepared for what's going to happen in a downturn. And I don't think it should be, well, we're going to stick by the dividend. The dividend should have gone. And my initial concern was that at some point they are going to basically ask you for all this dividend money back again in the form of an equity raise when they're bumping up against their net debt levels being too high. As it is, net debt's now, as you said, slightly higher. It's up at 88.4 million. I kind of don't mind it if they're doing the right things elsewhere. I can live with the idea that net debt's going higher. 1.7 times EBITDA is not crazy in a year where EBITDA's not at its peak. It's kind of absolute peak. You mentioned that things have been looking up here a bit, but plenty of reasons to like Forterra, but I don't like it as much as I did when I owned it. Its balance sheet is still now significantly weaker, and I don't want stuff to go wrong here. I do like them as a company, though. I mean, the way I think about bricks here is one of two ways, basically. Either, because I can't be bothered to figure out which is the right one, either you think brand matters in the brick industry and name matters, in which case the London Brick that you pointed out as one of their lines is probably the best asset in this industry to have. So, okay, if brand matters, they're good. Or you think brands don't matter, in which case it's all about commodities and it's just about basically cost and who can manufacture things the cheapest and get them somewhere the cheapest. One of the big things driving the kind of investment thesis behind this was historically not enough bricks produced in the UK to meet demand. We import them. It's got to be cheaper to produce them, or basically anywhere in this country, and then get them to where they need to go. And if you've got a nice, fancy new, and more efficient, most efficient in the EU, I think, facility at Desford as it was at the time, that would be a bonus like that. So if you think they're a commodity, great. We've got lower pricing costs. And if you think brands matter, cool, we're good at that as well. So still plenty to like here. The stock is now above where it was when I sold it, which means I will stubbornly not buy it back again. It's about 10% higher than it was where I sold it last July. Probably not, Steve, but if I see that balance sheet improving, I could see my way to getting interested again.
Yeah, so while you were talking to Steve, I was just pulling up some of the stuff that we didn't like in the in the last financials. So when we went over the stock last time, I mean, revenue was down 24%, EBITDA was down 35%, PBT was down 56%. The brick revenue was down 26.2%. Net debt was up in the 95 millions. Inventory had doubled, and they'd drawn down about 2/3 of their credit revolver, meaning they were about 3 times leveraged come the end of the year. The covenant was broken essentially. And yes, that was kind of like the deal breaker for me and you there at the time, especially as they were still paying a dividend, and we were like, just cancel it, man. There's just absolutely no reason to have it. Now I'm looking at some of these stats now. Not massively improved, to be honest with you, Steve. The revenue is about where it was. It might finish about 5 or 6%, maybe 7 or 8%, depending on how good the second half of the year is, above those figures that we didn't like at the time. The cash position, they did have 16 million at the time, of which they were paying out about 4 million on a dividend. The cash at the moment is 15.2 million. Obviously, there's been some capital investment in those two factories, so we can think about that how you wish. The dividend obviously is now much smaller. It's about 3p a share, so that should be a lot less. But generally, Steve, it is getting better, but it's not hugely better than when we sold it. Now, I was looking at the sort of prices of when we sold it as well, Stephen. We sold it in the sort of 170p kind of range. And at the beginning of the year, it was in the 160, 150 kind of p range. And at the moment, it's in the 197 kind of range. So 22, 23, sort of 20, maybe 20% above where we got rid of it. I don't think it's 20% of a better company at the moment. So there's definitely a little bit of exuberance priced into this, to stock. And I'm not quite sure it warrants it yet. These results are better, but they're not great. And I think that's kind of where I sit on it at the moment. It would have been an interesting one for our brick box, but it's probably not there yet when we think about quality. It's a shame, really, because prior to this, it was the quality outfit, and it had the best products, and it had a moat for brickmaking was interesting. Perhaps the moat wasn't as strong as we anticipated, because, well, I suppose a moat's only as strong as demand. It didn't. The moat in this case was about the brick specifically, and not really about how how in demand that brick was. So yeah, I think it's improving, but I don't think it's 22% improved, and for that reason, I don't even think it's on my watch list anymore, Stephen. I'm not entirely sure. I'm gonna put it there. What about you?
No, you're now in some different places in this kind of, if we talk about it as a value chain for the time being. There was one more bit of a bear thesis, not necessarily that, but perceived risk, let's say, with the stock, which is, if you think about the kind of obvious reason people get interested in brick companies in various ways, it's because, well, look, we think there's a clear shortage of housing in the UK. That much is true. Sooner or later, people are going to have to build houses to do this. That is true. The current government is interested in helping it along. That is true. Can't necessarily tell one house builder from another. In quite a few cases, that's true. There's one or two that I think have something unique about them, but including Vestry, but generally speaking, that's also true. So you think, well, let's just buy the brick company then, because I don't care who's building all these things. They're going to make them out of bricks, aren't they? And one kind of issue was potentially the thought that construction techniques might move forward a little bit to reduce, in general, the number of bricks that are used in building houses. You talked on this show, I think, quite a long time ago now, about passive house and the kind of rise of that movement. I'm now starting to hear about that in places that are not you, which tells me that it's quite significant. In fairness, it was from someone who was doing MA in sort of architecture and design based stuff. It might be an MSc, I'm not sure. So it's still fairly specialist on these kind of things. But I guess that's another reason for being just a little bit thoughtful about how far you want to get in for this. It's not like it's necessarily a way of sealing off the only supplier in the thing that has to be used to build houses. Will they keep building houses out of bricks? Probably. Will they be Forterra ones? Probably. But worth being aware that that's at least a live dynamic that you probably want to have something to say about in your own mind if you were considering buying this, I guess.
Yeah, and so just on the subject of passive house, one of the things I bought when I'd sort of lost patience with Forterra's management was Zender Group, who trade on the Swiss exchange, pretty much because I spend a lot of time on sites, going to view things, especially when there's a passive house being built. I love to go and see these buildings. They're very strange. I think I've explained this before on the podcast, but because they're airtight, the air has to be fed in from the outside using a HVAC system or something similar like that. And these systems kind of pump in filtered fresh air, and they take out the exhaust, the bad air, and they do this on a constant basis. And it's a very strange feeling going in and breathing completely filtered air. It feels really fresh, like you're walking out in the countryside somewhere. It's very, very strange. But the company that kept coming up again and again and again was Zender, and we got the opportunity to work with them last year on a fairly big site, and they were using our products, and we were using their products, and there was some good synergies between the two of us, and I realized what a fantastic sort of outfit, a really good professional outfit they were. So I went and had a look, found that they were listed as a Swiss company, and bought probably one of the lowest liquidity Swiss companies going. But yes, it's done really well for me, Steve. It's about 37.5% this year already. So yeah, I've been really happy with this one, Zender Group, and I think if we head more and more and more towards making cavities bigger and bigger in buildings and filling them full of insulation, we're going to accidentally make them too airtight as it is. So we're putting more panes of glass in windows. We're putting polyurethane doors or whatever they're called to keep the heat in. We're now putting more and more insulation in to keep the heat in. We're using insulated plasterboard, blah, 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 blah. We're going to end up cooking ourselves. I think HVAC systems, heat pumps, that kind of stuff is all going to end up being pretty much needed in new builds all over the country, and obviously in older builds as we bring them up to regulation. And yeah, I just think Zender Group is better positioned. So I think I've gone a little bit across the way in terms of Forterra to Zender, but I'm much more comfortable with this company having a lot more sort of first-hand experience with them.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.